Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. This is Michael Hartzman on Tuesday, February 16th, broadcasting you live from Long Island, along with my partner, Dominick Tavella, who's broadcasting today from Florida. Good for you, Dominick.
Managed to very luckily escape the storm. So sorry, Mike, but I have to do it from down here.
Good for you. Congratulations. I'm jealous. Although we did have a kind of a spring day today, but we still have about 8 inches of snow and about 8 more coming on Thursday. So stay down there as long as you can.
As long as I can, but working. So here we are again, Mike, a week later, looking at what's going on in the world, looking at what's going on in the markets. So I'll let you take the lead on that one.
So 2 weeks ago when we had Louis Navalier on, who was a great guest, he mentioned 2021 being like 1999. And I'm not going to lie, my heart skipped a beat because everyone remembers what happened in 2000 and 2001 and 2002 and 2003. We had this great market in 1999. And then, we had this prolonged bear market, which was torturous. And so this Saturday, my Barron's, as always, shows up, in my driveway. And I open up to page 7. And the first thing I see is today's stock market differs from 1999. Or today's stock market mania differs from 1999. That may not matter. So once again, my heart skips a beat. I'm happy I'm consistently taking my blood pressure medicine. And one of the expressions I always hate is this time it's different. So when you hear this market's like 1999, it always gives you some reason to, really evaluate that and really see if that's true. And some of the factors between 1999 and 2000 are a little different. And before I get into that, just let me remind some of our listeners and viewers that 1999 was kind of the apex or the early, which ended in the early 2000 of the tech bubble and the stock market bubble. And as you like to say, your favorite example is pets.com, where they all imploded and vanished. And the difference, I think now between then, the primary difference between now and then, Dom, is back then when the stock market imploded, treasuries were 6%, right? And now they're about 1%. So there's still not many places for people to run and hide. But it still makes me nervous, and it still gives us reason to always be somewhat cautious, not caught up in the euphoria when you hear it's 1999 again.
So as I do almost daily, Mike, I'm sure you do as well, clients are very concerned, and they're very concerned with the speculative nature of what's been going on in the markets. And we all know the names, the Bitcoins, the GameStops and such, right? But I don't know if this is good news or bad news. My opinion is it's not 1999. That's the good news. The bad news is it might be 1997. And the reason I bring that up is that in 1997, we were all looking at the markets and we were looking at valuations, and it just didn't feel right. We didn't quite know what, we didn't quite know why, but we thought there were parts of the markets that seemed a little frothy, that investors were taking a little bit for granted as almost a sure way of making money. And, we were cautiously telling clients, I don't know if that company's worth X. I don't know if you're supposed to double your money overnight buying some speculative investment. But we didn't quite know where that picture was going to go and how it was going to end. And then 1998 came along and we got more froth and clients were getting more anxious on one side of the fence and more speculative on the other. And then 1999 came along where, the volcano literally exploded and came crashing down in 2000 and 2001. So I don't think we're in 1999 yet. But we're seeing, like 1997, a lot of parts of the market, not the entire market as a whole, but parts of the market that just don't feel right. And yet there are people that think this is normal and this is a great place to double and quadruple your money in a very short period of time. And you and I, and I'm sure Jordan later on in our conversation, we've seen this show before. Not quite sure when and how it's going to end, but I think we have a pretty good hint.
I remember back then, maybe it was 2000, 2001. I was actually invited to do an expo for seniors at Suffolk Community College here on Long Island. And a lady came over to me with a brokerage firm statement from a very large financial services company at the time. And she showed me her statement, and she used to have $300,000 of a stock called JDS Uniphase, which was now worth about $350. And she must have been a lady in her 70s. And she said to me, "Can you tell me, young man," because I was younger then, "when will I get my $300,000 back?" And I said, "Ma'am, I don't think that's going to happen in your lifetime. I don't think that's going to happen." And she turned around and she filed a complaint with the person running the seminar that I was rude to her. And my friend Frank said to me, "What did you say to her?" I said, "I just told her the truth." I said, "I don't think that this stock is going to come back in her lifetime." And obviously, I have no idea what ever happened to that company, but I'm pretty sure she didn't make back her $300,000. And to your point and to your joke about pets.com, the other reason that this does not feel like 1999 is that there are a lot of emerging sectors right now, whether it's electronic vehicles, whether it's solar energy, whether it's genome technology, and even Dominick, legalized sports betting is becoming more ubiquitous. And last night I was watching the Knick game, and they're touting, betting on the line in the beginning of the game, which would have been unheard of a couple of years ago. So, and even pot stocks are coming to the forefront as states look at ways to close their deficit. So the other thing that I think is interesting is there are new disruptive sectors which are also making inroads, which I don't think was happening back then as well.
Yeah, look, back to my comment that I don't believe the entire market is frothy. I don't believe every stock is overvalued. And in fact, to your point, I think there's a valid argument why there are at least sectors of the market, if not many individual securities that are undervalued, because so many people are kind of leaning to one side of the boat, all concentrating on some of these speculative names, leaving the other ones kind of free for us to go in and start harvesting some of these companies and putting them in our portfolio. And yeah, we have to be a little bit more patient and a little bit more calm about our approach. But I think there's a lot of value there. You got to kind of push some of this other stuff to the side, some of these other names to the side, focus on good quality names, good quality companies, good quality sectors, a little patience. And I think we can give our clients a reasonable return. But we got to get past this noise of some of these very speculative names.
Yes, and here's the other flip side of it, right? You and I have a very retail client base who kind of count on us to keep them informed. And it's really fascinating to me. I would say about 25 or 30% of the phone calls I get on a daily basis, many people who don't check every day still think the market is underperforming. The market has problems. So there's also that where back then in 1999, it was the old joke, and Jordan has mentioned this in the past, you getting stock tips from the Schuheim guy or from, the taxi driver who took you to an appointment.
I had a call today that said, I thought once we had a new president in office, the market was supposed to crash. What happened? So look,
That's the news bubble. That's what happened.
Look, we don't have a crystal ball that works, right? We manage based on very disciplined, very sound, very fundamental data. That doesn't make us right. It just keeps us from hopefully making any really dumb mistakes. And to that point, we don't know how this game is going to end. We don't know when, if it's going to end. But we have a responsibility, as we've maintained many times, to be very prudent with people's money. And to that end, just don't make any dumb mistakes, right? How many times do we say that, Mike?
So I guess I can't help myself. It's just too easy. So I guess we're not partying like it's 1999.
No, I think you and me both will be in bed before midnight anyway. But no. And I think we've shown that you can achieve reasonably good returns without making the speculative bets. But should we go through an event, and we saw it just a couple of weeks ago when GameStop kind of had its moment in the sun and then not anymore, it can affect the rest of the market for a period of time, and that creates unwanted volatility for us, for our clients. And again, take the deep breath and hold on tight, and we'll hopefully get you through it in one piece. So those moments do happen. In 1999, it took us 2 years. That was wrapped around 9/11, another horrific time in our history. But we recovered, right? And clients recovered their assets. But if you own the garbage.com, the pets.com, you didn't recover, right? So we have to be incredibly careful about where and how we allocate.
And that's a great segue to also our next guest, who you and I are very, very fortunate that we do have access to some of the smartest people on Wall Street. And tonight we have the pleasure of bringing David Lebovitz onto our show, who's part of the global asset management team at JP Morgan Asset Management, works with David Kelly. And really, we've been in David's presence in the past in New York City when that was a thing, heading into the city. And I can't wait to hear his insights. And I think he's listening to what we said. So I'd love to get his opinion as well.
I'm sure he's more than, first of all, appreciative of his time and his generosity being with us and helping get this message to our clients. But we've been fan of them, and them have been partners with us in managing client assets for a long time. We love their style, their slow and steady approach. So very much looking forward to this next conversation.
Yeah, and I'm sure he'll be able to bring his own insight into his own wisdom into what JP Morgan is thinking these days. And JP Morgan is always able to provide us some top-notch information. They come out with this great guidebook to the markets every quarter, which we use constantly. So so David is coming up next, and we look forward to having him. And we will be right back right after this break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman along with Dominick Tavella, and we are thrilled to have David Lebovitz from JP Morgan Asset Management with us. He's a global market strategist. He works with, I guess, David Kelly's the chief economic officer at this point, or investment officer.
Yep.
David?
So I work as a strategist under Dr. Kelly, who oversees the entire Global Market Insights team. So we have people based in New York, people based in Europe, people based in Southeast Asia. So it is truly a global organization at this point.
We are big fans, as we said on the break. So we're thrilled to have you. Thank you very much.
Appreciate you joining us.
Yeah, my pleasure. Thank you for having me.
And I guess we'll just jump in. You did hear our first segment, and I'll just ask you the obvious question. Is there any equivalence between what's happening now and 1999, in your opinion?
So I think you're seeing some signs of, I think you guys put it very well. You are seeing some signs of froth in the current environment. But one of the things that we really always try to do during times like this, I mean, we've seen this type of investor behavior on many occasions over the course of history. And so, is it exactly like 1999? Well, there are some parallels there. There are some parallels to what we saw with Japanese equities in the 1980s, even some parallels to what we saw with tulips, right? Those hundreds of years ago. The thing we always try to think about is whether we're dealing with a bubble with a big B or a bubble with a little b, right? And a bubble with a little b is kind of like boiling water on the stove. You're going to have some bubbles reach the surface. They're going to pop. You're not going to make a big mess. A bubble with a big B is more like trying to boil a pot of milk. It's going to go everywhere, and you're going to spend hours dealing with the aftermath. And again, I think part of what's happening here is really twofold. On the one hand, we've seen access to equity markets continue to get taken down over the years. And, you look at the ability to trade commission free, you look at the ability to trade fractional shares, you look at access to information, right? A lot of the stuff that was historically reserved for the institutional investment community is now available to anybody who wants it on the internet. And you couple that with this cocktail of quarantine and liquidity that everybody's been served. And, it makes sense that we've begun to see these pockets of froth across the capital markets. And so when we see prices becoming disconnected from fundamentals, it always catches our attention. What we want to make sure of is that behavior isn't becoming too widespread. And I think at the current juncture, this behavior is relatively contained. You're seeing it in certain areas of the equity market. You're seeing it with certain crypto assets. You're not seeing necessarily widespread euphoric behavior, which would really be the flashing yellow light from where we sit. So, to us, this is more of a proceed with caution as opposed to run to the hills, because I think that as you guys pointed out, while there are some similarities, there are a decent amount of differences between where things stand today and where we were back in 1999. Obviously, right on the cusp of the tech bubble going pop.
And David, on that point, we've had pretty much, we're through earnings season right now, and about 80% of the companies that reported actually showed better top line and bottom line growth. And I think the average was above plus almost 20%. So we are seeing better, healthy numbers coming out of companies that actually reported.
You absolutely are. What I would say about the dynamic with respect to earnings is, to an extent, if you put a bar on the ground, it's pretty easy to step over. We saw estimates come down pretty significantly over the course of 2020. And so I think, the beat rate in and of itself isn't necessarily all that surprising. The magnitude of those beats, the surprise, as you pointed out, is really where we said, wow, the analysts completely missed the mark on what they were thinking around earnings in 2020. But, now's really the time where companies are going to have to prove themselves, because so much of the rally that we've seen in markets over the past 12 months has been based on this expectation that over the course of 2021, we're going to be able to bring the economy back online. We're going to see a strong rebound in corporate profitability, so on and so forth. And so now it's time for companies to deliver that, right? And I think that the ability for companies to beat estimates by 20% in a post-pandemic world is obviously going to be much more challenging. We think earnings growth is going to be good this year, but I think some of those distortions that you saw, which were really driven by the pandemic, are probably going to begin to fade. And the one thing we're really excited about is the prospect that corporate guidance is going to start to come back here. A lot of people were flying blind for the better part of last year, and we think that managements are now feeling a bit more confident in the outlook as they look ahead through 2021 and into 2022. And I think that that information will simultaneously help analysts like ourselves, do a better job at forecasting. Nobody talks about the fact that when earnings are beating by 20%, the analyst actually didn't do a very good job. And so, hopefully that gets tightened up over the course of the next 12 months.
Well, I want Mike to answer the question and ask the next question, but analysts just traditionally tend to be a little bit conservative in their estimates. I don't know if they missed it as much as they were kind of just being conservative in what they were putting out there.
Yep, no, absolutely. They overestimate far out and underestimate in the short term, but point well taken.
David, I mentioned in the first segment two sectors in particular, which I think have a little upside simply because it's a great way for states to close these enormous deficits, as a result of the pandemic. One is legalized sports betting, and the other one is marijuana. You look at New York City, where I know you worked. I don't know, it looks like you're not there right now. I know Jamie Dimon brought back the traders, but you guys aren't back yet. So number one, do you see sectors like that as a way for states to kind of passively, aggressively try to close their deficits without taxing their citizens anymore? And do you see, folks like you heading back to Manhattan at any point and things getting back to normal?
So a couple of thoughts there on the state and local revenue question. I think you're going to see governments, state and local governments, pull whatever levers they can grab. When we look at the amount of stimulus that we think is going to be part of this next bill that is solely dedicated to the purpose or for the purpose of supporting state and local governments, I mean, they have a heck of a hole that they need to dig themselves out of. And my home state of Connecticut is really the prime example of budgets gone wrong, if you will. And so I think that going forward, whether it's the legalization of marijuana, whether it is, an increasing legalization of sports betting, you are going to see states and municipalities leverage less traditional revenue sources in an effort to get their budgets back on a more sustainable long-run trajectory. But, I think you asked a really interesting question that is kind of indirectly tied to that point about the state of budgets going forward. And that's, when do we go back to work? And I'm firmly of the view that it's a question of when. I think that particularly for businesses like financial services, technology, law, the most valuable capital that these businesses have is their human capital, right? And human capital is something that is best developed in person. We've gotten very good at interacting, via various web conferencing technologies and doing things remotely, but there's something to be said from sitting down across the table from somebody and having an in-person conversation. And so, I do think that we will go back to work. I think, frankly, we are at the mercy of the virus and the ability to get everybody vaccinated in terms of what's going to dictate that timing. But I do think in general, working arrangements are going to be more flexible. I very much envision that when I go back to our office on Park Avenue, I may not have a dedicated desk in that building anymore. There may be a desk that I can sit at whenever I find myself in Manhattan, but maybe I'm working one day a week from my home office. I think that what the disruption that the pandemic caused to our day-to-day really forced us to take a step back and recognize that, we can do a lot remotely. We can do a lot like this. And that's coming from somebody who used to do 150,000 air miles every year going to see clients. If I can jump on a video call, that's a better use of my time, arguably a better use of the client's time. And so I don't think we're not going back to the office, right? I fully imagine that 12, 24 months from now, I'll be on the train commuting into the city. But I think the way we work generally will be very different in the aftermath of the pandemic. And the key word there is flexibility. You were seeing it begin to take hold in the run up to COVID. And I think that flexible working environment is going to be in full force in the aftermath of the pandemic.
David, the markets, I think, are clearly riding this wave that the vaccine is starting to come into the market, into the economy, into people's arms, and the economy is going to open up. But I think it's also taking a hint that we might get a pretty large stimulus package coming out of Washington. And as you alluded to, helping the states. What happens if we don't get the whole 1.9 trillion, that it's a more targeted, smaller package that would need support across the board to get passed. But what happens if we don't get the whole package?
So I think that, look, the market tends to be pretty reasonable. And if we don't get the full 1.9 trillion, I don't think that's going to be the end of the world. I think if we get 900 billion instead of 1.9 trillion, maybe that conversation begins to shift. But we're very much of the view that something 1.25, 1.5 is reasonable when all is said and done. And we do think that is going to be delivered. But I want to kind of take a step back to 20,000 feet and make a broader point that I actually wrote about for our blog on the minds of investors. And that's when you think about what's driven markets up until this point, right? It's been that view that the economy is going to come back online in a pretty boomy way. And there's been this view that policy is going to allow us to get there. And, you noted earlier that despite this lovely kind of springtime-like day that we had here in the Northeast today, there's still a ton of snow on the ground. And the way I think about fiscal policy is kind of like a snowplow, right? It's clearing the road and allowing consumers and businesses to effectively get to the other side of the pandemic. And if for any reason, right, we see an underwhelming response on the fiscal side, or I would even broaden that out and say, if we were to see the Federal Reserve begin to change its tune a bit sooner than what people are expecting, right, any divergence from expectations around policy that we begin to see could very well cause pockets of market volatility. And so we think that Congress is going to deliver what the market is looking for here in the near term. But let's not forget, they're talking about a broader recovery package for later on this year, things like infrastructure being tied into that. There is a risk here that maybe not in the next couple of weeks, but more broadly in the next couple of months, we start to see a little bit of disappointment on the policy front. And that ends up being a source of volatility for a market that has basically risen in a fairly uninterrupted fashion since we got the news on vaccines back in November of last year.
So, David, speaking of policy, the Fed has been on the record. They're not going to raise interest rates probably till early 2023. When do we start dealing about the deficit, thinking about it? When does that come into the forefront?
So I think that, there are three ways that you can reduce debt levels, which are obviously just accumulated deficits. You can grow your way out of it, you can inflate your way out of it, or you can pay your way out of it. And the challenge is growing your way out of a debt load is very difficult. Inflating your way out of it is very risky, and paying your way out of it through higher taxes is something that nobody really likes to do. But we've blown out the deficit last year. We're going to do it again this year to pass this next round of stimulus. I think that higher taxes are really much more a question of when, as opposed to a question of if. And I don't necessarily think that it happens in 2021, but I do think we see higher taxes on both corporations and individuals at some point during the Biden administration. And again, that's going to be the first step to trying to get our federal finances on a more sustainable trajectory. I don't disagree with anything that's happened here over the past 12 months, but I do acknowledge that the hole we're in is quite a bit deeper than where we stood at the beginning of last year.
And Dave, if I can throw out one last question as we've run out of time. The one that really worries me, and not a lot of noise right now, is regulatory risk. We're starting to hear rumors already, antitrust, going after the big tech companies. What are your concerns? Any ideas there?
I think anytime a given industry makes a lot of money for an extended period of time, it begins to catch the attention of regulators. We don't think that the worst case scenario is going to play out. I certainly don't think that these mega cap tech firms are going to end up getting broken apart. But I do believe that the rules of the playground, if you will, could be rewritten. And so, it's something where we're kind of watching it in real time. We recognize that there's risk on the horizon. We, again, don't see that worst case scenario playing out, but very much do view it as a risk primarily to valuations, right? Because part of what these tech companies have benefited from is a relatively sluggish macro environment over the past couple of years and very low rates. And they've made a ton of money in that type of world. If their ability to generate those revenues and profits begins to get called into question, elevated valuations are going to be the first thing that begin to slip. And so again, we don't want to draw any lines in the sand prematurely, but definitely view it as a growing risk as we think about the next couple of years.
Terrific. Thank you.
David, thank you. This was fantastic. Thank you for your generosity with your time and your insight.
My pleasure. Thanks for having me, guys.
Thank you so much. We could do this all day, but looking forward to the next time already. Thank you.
Thanks
again. We'll be right back with Jordan Kimmel and his guest this evening, Jeff Hirsch. We'll be right back.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel.
And welcome back, everybody. I'm Jordan Kimmel, the Chief Equity Strategist and Portfolio Manager. And it's really a pleasure, a privilege to bring on both a colleague, a friend, Jeff Hirsch from the Stock Traders Almanac. Jeff, thanks so much for joining us.
Great to be with you, Jordan.
Yeah, so Jeff, look, I have to set the stage a little bit. We go back a long time, and for everybody that has never been on a major trading desk in New York City, every single one of them had the Stock Traders Almanac on it, and it was just something everyone looked forward to getting every year. I had a dozen of them before I called your dad and said I wanted to come visit, and started a long-time relationship. But Jeff, you actually are running one of the biggest brands on Wall Street, the Stock Traders Almanac. We see you all the time on TV, and we'll get to dig a little bit deeper right now.
Quite humbling, isn't it?
Well, I want to just spend a minute on that because, when you say humbling, I know your family, and, Yale is a legend in the industry, and it's hard growing up as the son of a legend, but you're also the son of a saint. So the combination of the mom and dad, it's a nice combination. Growing up in your dad's footsteps. Look, I remember going there, and every newsletter writer I went to, I'll say one more thing and we'll get started, is I remember the old money shows where they had thousands of people and really great crowds. And I went to one with your dad, and it was like being with Mick Jagger at a rock concert. And it was a whole lot of fun. But so let's get into, why the Stock Traders Almanac had this longevity, and you're always quoted as there's a couple major trends. So no matter what your stock picking methodology, no matter what you do, you always want to add some seasonality trends and every advantage you could. So maybe you want to just describe the Almanac itself briefly and what it's meant to be.
I mean, it's a trading guide. Yale designed it so that he could follow the market's trends along with his own. It's designed as a calendar, like a desk planner, but it's packed with information, whether it's intraday trading trends or the best and worst 6 months that everyone knows, like Sell in May, or the January barometer that he invented, Santa Claus rally. So you're looking at, indicators, trading strategies, and just the general overall concept of what makes the market tick and how you can, relate that to your own individual portfolio maneuvers, whether you be a pro like yourself or mom and pop running their account out of their, their kitchen or whatever. So seasonals are very important. We all behave repeatedly, and Almanac tracks the, repetitive, consistent human behaviors of how they move their money around on a daily, monthly, weekly, intraday basis. And that's why we're around for 55 years,
Right. So on that note, the seasonality things, we're going to get into a couple of the major ones that you follow and what they're telling us right now in this market. But I'll also say that there's a quote every day, and I would take my interns and give them old almanacs and say, read them slowly. Don't try to rush them. If you understand what the meaning is behind every one of the quotes in the almanac every year, you're a legend right there. I mean, it really is deep thought. And so I love the quotation part. So one of them, let's just start with, and I'll paraphrase it, but if you don't learn from history, you'll continue to make the same mistake. So I didn't get it right. But the point is, here we are, we had a down January. We have a new president, the first year of the presidential cycle. Tie all this together. No one knows the future, but again, through history, it doesn't rhyme. It doesn't repeat, but it rhymes.
That was Twain, I believe. The down Januaries are important. January barometer is there for a reason. A lot of decisions get made in the month of January. And, as January goes for the S&P, so goes the year. It's not perfect. Nothing is. Even with all the flat years, it's about a 73% accuracy ratio. But we've had the privilege of standing on top of Yale's shoulders, and we've sort of built on the January barometer and created something called the January indicator trifecta. There's always been the first 5 days early warning indicator. That was something that was around before Yale did the Almanac. And then his Santa Claus rally, which is the last 5 trading days of the year, the first of the new year, when you don't get that little first 2 of the new year, when you don't get that nice little move, it's a warning sign. His famous quote, if Santa Claus should fail to call, bears may come to Broad and Wall. But we had a positive Santa Claus rally, positive first 5 days, and we had that sort of another COVID-driven end of January sell-off. So 2 out of 3 is not so bad. And we've seen, it would have been great if we had the trifecta of the last 31 times, all 3 were positive. 28 full years were up for about a 17.5% gain on average. 27 of the subsequent 11 months of the 31 years of the 11 months were up for about a 12.5% gain. But 2 for 3, still a pretty decent amount. There's about 11 of those. You see some sizable gains out there. So while we're concerned, with every single down January since 1950, you have a flat year, a new or continuing bear market, or a 10% correction. I think we're probably more in that 10% correction area sometime this year. We've got the Fed booing the market. Post-election years, as you were saying, historically negative. They've gotten a lot better in recent years. And new Democrats, we've got 4 since World War II, Kennedy, Carter, Obama, and Clinton. Almost forgot Bill. And only the Carter year, all came in with full Democratic controls of Congress. Only the Carter year with the stagflation in the 70s was negative. So just because it's a post-election year doesn't mean it's horrible. Midterm years are still the more difficult year with midterm bottoms in there. But we're still bullish. Worried about some potential weakness seasonally here, end of February into March, also during the worst months. Right. But my best case and base case scenarios are still in play. We're looking for something around 4,200, 4,300 S&P, give or take a little bit.
Right. Well, that's pretty positive. And again, we have we could feel the wind behind our back. I know that, frankly, when I met you, it was right around that 97, 98 period that they're talking about in the early segment. And, and while there is some froth, I do believe that there's something even bigger that you've talked about. And I, frankly, I've thought about where we are in the cycle. Yale and yourself have boiled it down to war and peace sometimes. That's simple. And I don't know where we are in the cycle.
That's the big secular pattern. And people, try to confine it to a particular time frame when it's really driven by events. So this was a pattern, I think you're referring to the old super boom pattern of forecast that I made based upon his work. I made it with the Dow at about 10,000 in May of 2010 for a 500% move for Dow 38,820. Back in 2010, people thought I was a little nuts. Now here we are, 30,000 and change, give or take, depending upon the news flow. And it's pretty much ahead of schedule. And this is based upon these market moves after war and inflation following World War I or World War II. And then his forecast from 76 was following Vietnam. And, I just was updating that big chart that he actually drew sort of with a lot of notes by hand back in the day. And we are ahead of schedule. I mean, the forecast was for that move to happen by 2025. I wouldn't be surprised if we get to that 38,000 number before then. So we are ahead of schedule. And I think, the QE and the interest rates are really pushing that. I mean, technology, the other part of that whole equation that we added is that the technological aspect, what I call a culturally enabling paradigm shifting technology, something like the microprocessor, or back in the old days, the combustion engine, the automobile, the airplane, air conditioning, indoor plumbing, if you want to go way back. But these types of things, and we have it now here with, whether it's the cellular technology, the biotech technology, the energy technology, all these things converging to make the world a sort of smaller place. These things that impact everybody individually and the planet collectively. And that's got me, pretty positive down the line. We're going to have our setbacks. We've seen them before, but the market seems to be resilient. And I'm not sure we're ever going to get back to those old historic averages for interest rates. I know they're ticking up a little bit right now, but the world's so huge and there's so much connectivity. I'm not sure we can get back to those old interest rates of yesteryear where, we've got higher, 4, 5, 6% long-term rates. I'm not sure that that's going to happen anytime soon.
Right. And Jeff, the fact is those normal rates you're talking about 5, 6 are actually historically high. Rates have been down in these levels, not zero. But it's pretty remarkable where we've come from in the years since we've met. And, I want to just mention that, I have this quantitative process, which looks at individual companies, but, it's more of, there's a lot of emotions that come into the market. And I like to say it's not the smartest people. And I don't think you'll know better than I don't think Darwin said it was the strongest that survived, but maybe the most flexible and the most adaptive. And that's what our last guest talked about. Maybe I want to share a couple of things along those lines, because I think you hit on it with the technology that's coming.
I mean, adaptation. I mean, first of all, emotions are the most important thing. I've suffered from my own emotions. That's why we have other people trade our ideas now. Okay. But that's the thing you got to keep in check for mostly, whether you're a professional, manager, or otherwise. You got to stick with your system. Yes, adapt it and change it if need be. But if you start letting your emotions come in there, like happened to a lot of people back in March of last year, you're gonna get burned, and you're best off checking those emotions at the door, going against your intuitions. If you got a stock that goes down, cut that loser short. If you got a stock that's up, don't take those profits. You let that winning stock keep going up. So emotionally, you can't be a trader. You can't be an investor. You've got to put that aside.
So Jeff, before we bring on Dom and Mike, I want to ask you a question myself. Mm-hmm. I want to kind of end my segment, my thought about what Yale talked about was the truth. And maybe you share the Loeb exercise you have in the end of the Almanac, not trying to pretend who we are, but your dad always said the truth matters more than everything else.
I've been talking about that. So as a matter of fact, my son came in the home office the other day telling me, Dad, can I have $100 to buy AMC? When the whole Reddit thing is going on. I'm like, what are you talking about? Where are you hearing about this? Reddit? No. So we go to the page in the Almanac where it says, if you don't profit from your investment mistakes, somebody else will. Performance record. I wrote down the ticker, my son's name, the price, the date. Yeah, it popped up like doubled the next day. And then it went down a few days later below the initial price. So The truth, comes with keeping track of what people tell you, whether it's an advisor, a manager, a newsletter writer, or your friend on the street, or somebody telling you about some stock. You keep track of those stock tips, and who's actually got the truth.
Or even yourself, Jeff. People are a legend in their own mind, and they say,
yes,
I trade real well. I trade technology real well, and then they take out the records at the end of the year, and it's all about the truth, not about what you hope or think.
And then there's that hubris thing you got to be careful of. The walking on water indicator we used to talk about. Where you're your own worst enemy when you're doing very, very well, and you start to get a little cocky, and you forget about the truth that brought you there.
Right. Well. See, right now, Jeff, I've shared in a note that I've written recently. The wind is behind our back. Don't take credit for the wind. We know. Don't confuse brains with the bull market. You basically have every quote, folks. If you go to the Stock Traders Almanac and just
what about Galbraith?
Say it again.
John Kenneth Galbraith. Financial genius is a rising stock market.
There you go. And there's a lot of sweet air right now. A lot of people think perhaps they're a little smarter than they are. But I think that when you break it down to the discipline of knowing who you are as an investor, controlling your emotions like you talked about, and then adding some seasonality to you. But you know what? There's only two things you could do, Jeff. You could either trade and get experience, or you could read books. I think you really need to do both. And when your top 10 books of the year came out, I simply bought every one of them because that's what I thought you needed to do. I still think that I look forward every year to the Almanac coming out. I'm glad you joined us. I'm glad you're prospering in this market. I know you've added not only your insights, but some trading to some other firms you're working with. And hey, Jeff, I just want to thank you for coming on. It's been a long time,
Long
a lot of years, and I'm very proud of what you do with the Almanac, and glad you took the time with us.
Great having me. Thank you, Jordan.
Alrighty, folks, we'll be back more with the Lebenthal Report following this quick break. Thanks to Jeff Hirsch. Thanks for joining us. We'll be right back.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. Now, back to the Lebenthal Report.
All right. So I'm Michael Hartzman along with Dominick Tavella. So Dom, Jordan, who's never at a loss for words, I think forgot to bring us back in, but Jeff was a great guest and he has some great insight.
I think both our guests tonight were amazing. And honestly, I think we kind of probably talked to each one of them for the entire hour. I genuinely, I know we say this a lot, but I genuinely look forward to the next time we can bring them back. And I was able to sneak in a couple of words to Jeff, but his comments about emotions, I think, is so important for us to keep it, top of our list, because we can do the greatest job in the world. Portfolio managers can do the greatest job in the world of managing risk and trying to get the best total return. But if emotionally you decided to get out of in last March when you just couldn't take it anymore, or you bought in at the top of the market because you thought you were missing out, then you blew the whole plan, right? You just took the whole game plan, the whole strategy, the whole long-term investment philosophy, and you just threw it out the window.
Yeah, and there's another expression in our business. There's an endless amount of them. And this one I really hate, but there is an expression in our business that there's only two things that motivate markets: fear and greed. I really hate the word greed, but what it's really saying is, at the end of the day, people are going to stay in a bull market longer than they should, and they're going to stay out of a bull market longer than they should, depending on which emotion they're experiencing at that moment.
Look, Mike, I always use the word blessed, and I mean it sincerely. We had an awful lot of trust from our clients last March, and the significant majority just held on tight. And I know it was a rough roller coaster ride, right? But they benefited from that. The trust they gave us and the faith they put in us, it worked out, right? And I appreciate it doesn't always work out, but we're internally grateful that they gave us that trust. And but if you bailed out, as we like to say, if you got off the roller coaster ride on the way down, you got hurt. You really got hurt, and you pretty much threw a monkey wrench, and that's being polite, into your long-term financial plan.
Absolutely, especially if we're sending you, or if we have someone who's not a client of ours listening, if your financial advisor is sending you money every month, and you were out of the market for the last 12 months, you've created a decent dent in your portfolio. There's no doubt about it.
So back to that responsibility that we feel, but blessed. So far, so good. And I think both our guests talking about this long-term investment mentality and strategy really adds value to us and how we manage our portfolios, and to the clients, hopefully, that are taking their advice.
Yeah, I know. And look, eventually we are going to have to start talking about the deficit. We are going to have to talk about raising taxes, and we are going to have to talk about, how we're going to pay for all this stimulus. It's great, whether it's 1.4 trillion or 900 billion, which are insane numbers. It's great. We should be helping people now, but we can't keep kicking this can down the road forever. The bill's going to come due.
Yeah, and I've mentioned the term helicopter money. I think, Congress has to be a little bit more responsible about just how, where, and when these dollars go out. I mean, in a perfect world, if you got the money sitting there in $100 bills, yeah, give it out. Who cares? But we know every dollar has to get borrowed. We borrow every dollar that goes out in the stimulus package and a stimulus check. And so that IOU is going to be due someday. And we don't want it to be our children or our grandchildren making that payment back.
Yeah, hey, look, as you and I both talked about this. The people who genuinely need help should get help. But
Absolutely.
for the millions of people who just took their stimulus check and bought GameStop or Tesla, I mean, yeah, it's great for our business, but that was not the purpose of any of this. So there has to be a better way of vetting the people who actually need the money.
Well, we hope certainly some sanity comes back to Washington, and God forbid they actually play nice in the sandbox and cooperate. I know it's wishful thinking, but why not? Why not? If you're going to have some wishful thoughts, let's hope everybody plays nice in the sandbox and does the right thing for the country.
Well, let's end it on a high note, my friend. That's a great thought.
We can hope.
It was a great show. I'll see you soon. And thanks everyone for listening this evening.
Good
Have a
evening,
good night.
everybody, and be safe.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.